You are certainly at the forefront of innovation and entrepreneurship, and I'm thrilled to be part of such an important convening. And I'm here to talk about one of my favorite topics, our economy, based on my experience working not just on the financial crisis, but on the recovery itself. Starting in 2008, and then serving on both terms of the Obama administration as Treasury of the United States, and most recently as part of the President Biden Treasury transition team. So it is, in fact, I think I'm the only person in the world who've ever served in those capacities, and my work continues to this day. Just a little bit of background on myself. Prior to coming into the administration, I was Managing Director of Investments for a $22 billion firm based in San Francisco. Right out of college, I graduated from Harvard University. I was a commercial property underwriter for general reinsurance, so managing risk is in my blood. Now, I remember the crisis of 2008. How can we forget that? I was working in the investment management firm at the time in San Francisco, and I received a call in October of 2008. You might recall during that time that Congress was trying to pass the legislation that would become known as the Troubled Asset Relief Program, and it had failed in its first attempt. And at that time, again, I, as part of this real estate investment management firm, was feeling the effects of the crisis. So when I received that call asking if I would be interested in coming on board to be part of this Treasury transition team, should President Obama win in November of 2008, I would be part of that team that would implement the Troubled Asset Relief Program, working closely with Secretary Paulson and President Bush. And of course, when you get that call, you can't really say no. It was a very, very scary time, and I can't help but think how quickly our memories tend to overlook what was happening. It was frightening. And as one of about 24 finance professionals who were brought in, literally we were in this room in November of 2008, about 24 of us who were brought in to, again, work with Secretary Paulson and President Bush during this time of uncertainty, probably one of the most uncertain times of our economic history. We worked in teams, sometimes as individuals. Sometimes we were given a week to turn around a recommendation on a specific project or initiative. Sometimes we were given an hour. And again, something that still stays very, very close to my mind. Just to give you a little bit of a glance, I'm going to go over 15 years of work in about 10 minutes. The cause of the great financial crisis lay with homeowners, the U.S. government, lenders, rating agencies, regulators, investors, and financial organizations for taking on too much risk. It ended in 2009 after massive monetary and fiscal stimulus, along with government rescue of banks, were put in place by the Troubled Asset Relief Program. So if you look at this particular slide, you will see exactly when real GDP growth contracted. Financial innovation and risky products caused financial firms to become more interconnected, but outstripped our ability to manage the risks that innovation brought. We saw a rise of inexpensive mortgage credit in the U.S. and elsewhere that set off a housing boom, but when housing prices started to fall, excessive debt and structural weaknesses set off a domino effect. Now, even though when President Obama took office in January of 2009, our economy was still drastically contracting. In fact, that month, January of 2009, the economy contracted at 6% GDP. So here we were assuming we were going to grow anywhere from 2 to 3%. So contracting in 1 month at 6%, you can imagine what we were all feeling at the time. And at the same time, the economy lost over 750,000 jobs in 1 month. So whenever you see the results come in from the Bureau of Labor Statistics on the monthly jobs number, anything that's positive 200,000 jobs is good. That's a really good number to stay above. So when you think about 750,000 jobs in 1 month, just to put that into perspective, at that time that was about the population of San Francisco, my hometown. So if you can imagine the entire hometown losing all their jobs in 1 month, that's the reality that we were facing in January of 2009. So the nation's credit markets were still frozen. Bank lending was almost non-existent. The municipal market for debt was in deep disrepair, leaving states and localities cash-strapped. And again, we still were not out of the woods. We still had a lot of work to do. But as you can see from these slides, the financial firms were still very much feeling the loss. You can see this as you can see what happened with triggering the worst Great Recession since the Great Depression, which ultimately destroyed 9 million jobs, shrank the economy by hundreds of billions of dollars, and the crisis was caused by, among other things, again, this housing boom, as shown in the slide that you can see. The severity of the crisis is also illustrated by the rapid increase in corporate bond spreads in the fall of 2008, as well as a dramatic fall in household net worth. And I do recall when I sold my house in 2009, not exactly the best time, so I think we were all feeling it. So one of the things that was very important at the time that we all came together, again, during this very unprecedented time, was a set of core principles that we worked on with both administrations. So again, this is working closely with the Bush administration so that when President Obama took office, there would be a natural alignment. And this strategy included these core principles that you see in front of you. A comprehensive, forceful, and sustained response. We needed to act quickly and consistently. A categorical promise to prevent a catastrophic failure of the financial system, and a pledge to support hard-hit families. It was working at all levels. Main Street, the inequality that existed and continued during that time, along with Wall Street, and the goal of mobilizing private capital wherever. But the aftershocks continued for years with subpar growth and low inflation into this decade. From an economic perspective, the global financial crisis highlighted that fiscal and monetary policy do work. There is a role for government, central banks, and global cooperation in putting free market economies back on track when they get into a downward spiral. But the work continued even beyond the Troubled Asset Relief Program. As I mentioned, we set up the American Recovery and Reinvestment Act, and in addition to that, in 2012, Congress passed what was known as the Dodd-Frank Act legislation, which included unprecedented steps for Wall Street reform. As you can see in this slide, it included clear guidance for specific oversight over what were considered as our traditional banking systems, which now included traditional banks, but also non-bank financial companies, swaps and derivatives, hedge funds, investment banks, clearinghouses, and exchanges. It also set up the Office of Financial Research in order to look at the empirical data to foresee and perhaps even forecast any other anomalies in the system. It also included the formation of the Financial Stability Oversight Council. This includes all regulators within the federal government, including the Federal Reserve, and is chaired by the Secretary of the Treasury. This group is so important, especially today, as you see other innovative programs, whether it's crypto or other assets coming into light, that allow the government to act quickly and swiftly with those regulators in place, ready to go. So what were the key takeaways that we saw from the first financial crisis of 2008-2009 era? One, consumer behavior is the hardest to change unless there's a shock to the system, and I will introduce what that shock is in a minute. So debt, housing, spending, there were definitely patterns here, but there are now new patterns. The fundamentals of the job market have evolved. We now have the gig economy. So, for example, in the United States, here's a great question for you all. Is an Uber driver considered employed or unemployed in the U.S.? The answer is, as is the case for most economic questions, it depends. In this case, if an Uber driver is actively seeking other employment, then he's considered unemployed. But again, those are factors that we would never have thought about in the previous economy that we are now faced with today. And of course, shifting key demographics will influence economic and social behaviors. There is a whole new generation of investing, saving, and spending that is coming to life in millennials and post-millennials, which I will also discuss in a minute. But in the meantime, welcome to the new disruptor. Certainly the pandemic has caused a social, political, and economic tsunami that we would never have anticipated. and I mean no one. So here I was serving 8 years in the Obama administration, and again, that first period on the transition team, and I get the call again from the White House asking if I would come back to be part of President Biden's transition team. You can't say no. You just can't say no. So there I was again. It was in the middle of the pandemic, and our conditions were so different, and our transition teams were very, very different than 2008. Even though we were there physically in D.C., actually I was flying back and forth to San Francisco where I still live, that interaction, that personal interaction that we had with the first transition team of 2008, we couldn't have because of the pandemic and because of the shutdown. So our interaction was unique and very challenging. And it was, again, a very different set of circumstances. The pandemic really was not very consistent in terms of how it was being, how resources were being deployed and how we had to take that over. There was also uncertainty for our new normal, that same uncertainty that exists today. And again, a whole new reinvention of the labor force, again, much of it driven by technology and innovation, and a lack of clear guidance and regulation on some of those new technologies. So again, this is our shock to the system that we were faced with then, and quite frankly, we're still faced with today. So in the spring of 2020, as COVID-19 spread across the global economy, we saw factories around the world shut down. People stopped eating at restaurants, airlines grounded flights, millions of people were laid off as businesses disappeared practically overnight. The unemployment rate in the country shot up to nearly 15% from about 3.5% in February of 2020. It was the sharpest economic contraction on record. At the same time, the Fed implemented emergency stimulus measures to keep financial markets from tanking. The central bank slashed interest rates to near zero and began pumping tens of billions of dollars every month into the markets by buying up corporate debt. In doing so, the bank likely prevented a full-on financial meltdown. But keeping those easy money policies in place over the past few years has also fueled, you guessed it, inflation. The unemployment rate at 3.5% and then straight to 15% in February of 2020, again, really was a wake-up call for all of us. The Federal Reserve and the executive branch immediately stepped in with emergency stimulus measures, once again to keep financial markets going on and aid to Main Street. Interest rates were near zero and the Fed began buying up corporate debt, and all these efforts combined likely prevented a full-on financial spiral. But as you know, we are faced with some more interesting challenges ahead, and it's still not quite out of the woods. Thank you. Thank you for fixing that. So, not done. All right, so here's the best slide. Here's the best slide. This is my slide, and it's like this is the tale of two economies. In the U.S., the unemployment rate at 3.6% today. Conversely, in the wake of the great financial crisis, we had an unemployment at 8%, even as late as January of 2013. Real estate, my neck of the woods, even taking into account the impacts of inflation, real estate investors had a much more difficult time in 2008 so far. Again, one of the key origins of the financial crisis of 2008 was the housing market crash compounded by convoluted financial derivatives that few properly understood. There's no doubt that in most markets, real estate in general is still struggling because of rising interest rates and an unprecedented amounts of certainty and global economic challenges with many businesses who have not announced any meaningful back-to-work policies. My hometown of San Francisco is a ghost town. You could go bowling in Union Square and not hit anyone. It is still very, very unfortunate to see how my city is going to evolve in the future. Still, today is nothing like it was in 2008. So one thing to keep in mind, again, because real estate was such a big part of the crisis of 2008, is looking at housing supply, which few people realize. This is a really interesting statistic. From 2000 to 2010, U.S. home builders produced 27 million homes. The next decade, that number plunged to just under 6 million, according to the Census Bureau data. This is what has seriously impacted supplies today. Not good if you're trying to buy a home, but it could mean that an increase in home prices' current uptick may be more sustainable than it was in the mid-2000s. Inflation, without question, is much worse today than in 2008. Prices as measured by the Consumer Price Index are rising faster than any other time since the 1980s, and that's on top of big gains in 2021. That wasn't a problem in 2008 when interest rates were near zero and the economy still wasn't growing. Now, in 2022 alone, the Federal Reserve raised interest rates 7 times, and now with the recent quarter point increase, I think it's safe to say that the Fed will continue on this path for the foreseeable future. Stocks, you saw in my previous slide how the financial crisis of 2008 was punctuated by dramatic moments that illustrated how the stock market was performing. But 2008 was much worse for stocks than 2022. And when you factor in inflation-adjusted returns, the performance of the S&P 500 in 2008 was only about 10 percentage points worse than in 2022 so far. Beyond the numbers, however, in 2008, it really did feel like the entire financial system was collapsing. I do not wake up sweating in the middle of the night like I did in 2008, 2009. Again, I just think people have very short memories. It was an absolutely frightening time, and being right in the eye of the storm in Treasury, where I saw President Bush coming over from the White House very, very often with Secretary Paulson, who, by the way, I need to give him an enormous amount of credit on the leadership that he took in really commanding that scene. Bonds. This is a very interesting and very different story today than the stock market. Bond prices typically move in the opposite direction as stocks. When stocks are down, bonds are up or down by a lot less. You add fixed income to your portfolio to provide ballast, and they largely performed this function in 2008, declining only 4%. That is not the case now, although it changed a little bit at the end of last year. Thanks to sky-high inflation and rising interest rates, bonds have taken an epic beating in 2022, getting a little better, and eventually higher yields could benefit bond investors, but this is an extraordinary anomaly whose big comeback has yet to be realized. And the last one on the slide, gold. Who would have thought that gold would not be the safe haven that it should be? In 2008, many investors turned to gold as stocks took their hit and the sky was falling. This is certainly not the case in 2022 with stocks nosediving and prices increasing due to inflation. Gold has been a huge investment disappointment. This is another great example of how the fundamentals have changed and has tested gold's reputation as an inflation hedge. So, what happens next? There is no single government or central bank that can fix the inflation resulting from these global disruptions. At its January 31st, February 1st policy meeting, the Federal Reserve lifted its benchmark overnight interest rate by 1/4 percentage point to the 4.5%, 4.75% range. And as mentioned, the central bank also signaled more rate hikes are coming to help lower overly high inflation levels back to the 2000 target. So what does this mean for you? First of all, not out of the woods. We still have our geopolitical uncertainty with the Russian invasion of Ukraine. We still have what could be a pandemic that still hasn't quite disappeared completely. Hopefully there'll be no more variants that'll come back. Prices and wages are likely still going to go up for a while, but for how long and how much depends on countless variables across the globe, including any further lockdowns in China that might affect our supply chain. No telling what other natural disasters, like we're seeing in Turkey, could also set us back in progress. And again, any other variants that might be rearing its head with the pandemic is something we just cannot control at this point. So what would I do as an investor? One, I would follow the money. Yes, it is my name on U.S. currency, almost $1.8 trillion with my name on it in currency in circulation, so no one has made more money than I have. But if I were following the money, Where is it going? It's going to the metaverse, it's going to blockchain, it's going to artificial intelligence. Technology and innovation will be the key. And here's what's important to remember. In 2007 and 2008, we saw a huge growth of investment in technology and innovation. This was during the downturn. What was invented in 2007 that has turned our world upside down today? Anyone? The iPhone. Very good. The iPhone was invented in 2007. There is no doubt, and then obviously subsequent to that, you saw Facebook, you saw Google, you saw Airbnb, you saw Uber. In one of our biggest downturns, innovation still mattered. And that's going to still be the case. This is a very resilient global economy, and a lot of that innovation is happening here. Absolutely, it's happening here. But when I think about the pillars of capital, financial capital, physical capital, intellectual capital, it is human capital that still remains the best investment to make. And I know that's happening here in this country. I know it's happening in the U.S., and I want people to remember that this relationship that the U.S. has with India is so important. You might recall that President Obama visited India twice during his administration. You also know that President Biden has had 2 in-person bilateral meetings with Prime Minister Modi. That relationship will absolutely, no doubt, continue. For the person who was born and raised in Silicon Valley, I know firsthand the economic, the political, and the social influence that the Indian community has had in the U.S. and in Silicon Valley specifically, and I know that will absolutely continue. So to all of you, again, even though these are still uncertain times, this is also probably one of the most hopeful and opportunistic times that I have seen in quite a while, and there's no doubt in my mind that that innovation also starts here. Thank you so much.